Start your day with It's the Business. Here's Phil Dobbie.
Today, lots of market enthusiasm. Last week it saw feverish selling off of government bonds. Was it optimism or was it inflation fears? I asked Kallum Pickering that question.
What we have is growing expectations that the advanced world will stage a robust recovery from the pandemic from spring onwards into summer and then over the next few years.
But is that overly optimistic? After all, we have new strains of the virus, including the one from Manaus in Brazil that ripped through a population that last year we were being told had reached herd immunity. But still, it's here now, and yet we're sending kids back to school next week.
Education is the priority. Getting all schools open on March the 8th is something that we've set our hearts on for a long time.
Too soon? We'll look at that today. Plus, Britain's financial future. Is it all to do with SPACs? With what? Stay with us, we'll explain it all. It's Tuesday, the 2nd of March, 2021. Good morning.
And now, it's the business, making sense of it all with Phil Dobbie.
So there are some who argue that inflation is making a comeback, and there are some small signs of it. For example, manufacturing data from the United States yesterday show that the prices paid for inputs into the manufacturing process. So, for example, if you made furniture, has the price of wood gone up? If you make takeaway curry, those tin foil containers that you never know what to do with afterwards, have they gone up in price? Whatever it is you buy in to make whatever it is you make, have those prices gone up? And look, it looks like they have in the United States, according to the Institute of Manufacturing, the ISM, their survey. It's gone up from an index value of 35.3 for input prices in May last year, which was admittedly the lowest it's ever been, up to 86 yesterday, but which is quite an increase over the last few months. But that could be just a reflection of supply lines, because it's harder getting stuff. For example, there's fewer planes flying and production levels are lower. After all, there's a pandemic on. Have you heard about that? So maybe that's pushing up input prices and it won't be passed through to the consumer. But we will see, because there's still those who argue, irrespective of that, prices will go up because there's so much more money swirling around. And we're going to investigate that today. Look, the latest data from the ONS, the Office of National Statistics, shows 20% of the workforce is currently furloughed. 20%. It did get down to 11% in December. Of course, it was much higher in April last year. At its peak, it was 31%. But 20% is the highest since July. So there might be a lot of cars on the road, but there's a lot of people not going to work. So imagine when that furlough support is pulled away, how many jobs are really going to be left. I wonder whether Rishi Sunak is going to say anything about that in his budget this week, because it clearly needs to go on for a while. I mean, there is this question mark about whether these are zombie jobs, whether people are being kept on for jobs that will never return. If that is the case, we have to prepare ourselves for a huge spike in unemployment, because 20% of the workforce is currently furloughed. Now, the other question is, what's going to happen next week when the kids go back to school? I mean, we obviously have to do this. We have to educate children. They can't all make a living from being YouTube sensations. That probably is just the way for 25% of them. But the rest of them are going to have to do proper jobs for which they're going to need an education. And there is this big question now about, is it safe to do this? Because we've got this new strain which comes from Manaus in Brazil. Now, you might have heard about Manaus last year because amongst the herd immunity brigade, it was the poster child, because basically they let the virus rip through the community there. By October, almost 76% of the population had contracted COVID-19. And the infection rates and death rates started to slow. So people were going, look, herd immunity there, problem solved. Let's get back on with our lives. It had killed 3,200 people, which is about 0.2% of the population. If you extrapolated that to the size of our population, that would be about 135,000 people being killed. We're around that sort of number anyway. Although they have a much younger population in Manaus, so it would mean naturally it would be a much higher number that would die here because we've got so many old people. But this thing hasn't gone away, sadly. Herd immunity doesn't matter anymore because Manaus has this new strain. It doesn't matter whether you had it before or not, given that most people already had it. Now the hospitals are overrun. They don't have enough oxygen to cope, and 100 people a day were dying in January. Well, between 80 and 100 people proportional to our population, that would be the equivalent of 3,000 a day here in the UK. But again, much worse than that because we've actually got a much older population than they have. Look, 3,000 a day, the worst we've got up to is 1,200. So this new strain is a big concern, and it's here in Britain.
The 6 cases of the variant of concern that was first identified in Manaus in Brazil, that we have identified here in the UK, 3 in Scotland and 3 in England. We know that 5 of these people quarantined at home as they were legally required to do. We've been in contact with them and their families, and we're grateful to them for understanding the seriousness of the situation. We're putting in place surge testing in South Gloucestershire as a precaution, and I urge everyone to remain vigilant. 1 of the 6 completed a test but did not successfully complete contact details, and we're therefore asking anyone who took a test on the 12th or 13th of February but hasn't received the result back to please get in touch
before you spread it around. And we have another Manaus situation on our hands. Meanwhile, kids are still going back to school next week. My kids haven't been tested before they go back. There's no talk of testing yet, even though we've been told that every couple of weeks they're going to have 3 tests. But have the schools got that in place? It's Tuesday now. They're all going back on Monday. I just wonder whether this is the Cheltenham Cup all over again. But Boris Johnson knows about this new strain. He knows that even though a third of the population has been inoculated, we're still seeing almost 9,000 cases a day, and he's still pushing on with it.
What we're doing is embarking now on a journey, a one-way roadmap to freedom, and it's designedly cautious in order to be irreversible. That's what we're hoping to achieve. And some people say we should go faster. Some people say we should be more hesitant. I think we're going at the right pace. Education is the priority. Getting all schools open on March the 8th is something that we've set our hearts on for a long time.
Right, so it's just a date that you've had in your back of your mind for a long time. But why not dither and delay, given that you're generally so good at this? Why not dither and delay and not send the schools back until after Easter? Because it's just a few weeks ago. By then, more people will have had the vaccine, and we'd make sure we're not seeing more of this mutant strain emerging, and we've got it under control. There's so much optimism right now, isn't there? So many businesses working to the schedule that Boris has laid out. The worst thing for him, and for us all, in fact, for the country, would be for him to have to backtrack and introduce another full lockdown, rather than gradually easing the lockdown we have now and making sure it's safe for the kids to go back to school and they don't become the petri dish that spreads the virus further and wider.
It's the business, making sense of it all.
With Phil Dobby.
Now, later today, the Economic Affairs Committee is talking about quantitative easing. This is in the House of Lords, including Alistair Darling, the former Chancellor of the Exchequer. They'll no doubt be asking whether the central bank is independent anymore, and whether there's too much buying of public debt going on, and what is the relationship between the bank and the Treasury now and going forwards. And we're going to be listening into that tomorrow morning, playing some of the best bits. How exciting will that be? And analysing it with Steve Keane. He'll be joining me tomorrow morning on the programme. Now, notwithstanding what I've just been saying about concerns about this new mutation of COVID-19, there is a lot of optimism out there that the worst is over. And that's certainly what created a bit of turmoil in the markets last week. We saw a sharp rise in government bond yields, particularly in the United States, but in many other parts of the world as well. Bond yields, as you know, go up when the price of bonds go down, and the prices go down when people start bailing out of bonds. Now, that can be for one of two reasons. Either bond investors think the time is right for riskier investments because things are getting better, like putting money into stocks and shares, for example, or because they are worried about inflation, which is going to devalue their bonds over time, because they're a bit like cash, except they do pay a dividend. They do pay a coupon rate. So which one is it? Is it inflation, or is it the fact that things are looking good? And why did everyone change their mind on Friday and through to this week and start to get back into bond buying? And what's to stop this rush from bonds from happening again and impacting interest rates as we path, this uncharted course out of COVID-19. Kallum Pickering is senior economist at Berenger. Good to have you back on the programme, Kallum. So what caused those sharp moves last week? Was it optimism and the appetite to invest in riskier assets, or was it these inflation fears? I know you're probably going to tell me it's a bit of both, but also, does anyone really have a clue what's going to happen over the next few weeks or months? I mean, volatility is still the watchword, isn't it?
That's right. Indeed, it is a bit of both. What we have is growing expectations that the advanced world will stage a robust recovery from the pandemic from spring onwards into summer and then over the next few years. And because of the big policy response, especially in the US with the big borrowing and spending response, what we will get is a much more inflationary recovery than we have experienced over the last decade. So that's the fundamental context. Now for markets, what this means is the interest rates that bondholders were earning are no longer sufficient. So they demand a higher interest rate. They do that essentially by selling the bonds that they have. But then for equity markets, it has an important consequence because equity market analysts, when they try to figure out what price, what value a company should have, they discount the future cash flow by the interest rates that are on government bonds. So when those interest rates go up, they discount the cash flow by more. So what we saw is, kind of ironically enough, on the back of better expectations for the economy, we had a sell-off in bond markets, so losses in bond markets, and a bit of a sell-off in equity markets too. And all of this is essentially a good thing because it's a reaction to what will be a better economy ahead.
But where did the money go in that case? If it came off bonds and it didn't go into stocks and shares, where is it?
Well, a lot of it will just be sitting in cash, in liquid balances. And the way to think about this is markets are very forward-looking. So there's a great catchphrase in markets. You buy the rumor and you sell the news. And central banks are sort of engaged in this too. So for the last almost a year, we've been suffering a lot. The economy has been suffering because of the pandemic and the restrictions. But we've been building our expectations for the recovery. And what's essentially happened is central banks have aggressively pushed interest rates down across the market. And that has had the effect of pushing up equity prices and pushing up the value of bonds. And we've been doing this on the back of growing expectations for growth. But now we're actually at the cusp of that recovery, that sweet spot where markets have strong expectations and low interest rates. Now the reality is coming true, and eventually now those interest rates are starting to recouple with the underlying economic outlook, and that's where this current volatility is happening.
So doesn't it mean that this is a bad time then for raising that extra debt for this 1.5 or 1.9, whatever it ends up being? I think they're aiming for 1.9 trillion. I've heard that if you take out the allowance that's there for raising the minimum income, then it would be about 1.5 trillion. So maybe 1.5 trillion in new debt, if that's what's passed through Congress this week. I mean, surely the end result of that, if this is going to cause inflation and it's going to push up interest rate, force central banks really to respond, as well as seeing bond yields rise, they're going to have to bring forward their timetable for raising interest rates. I mean, that negates the work of the government in putting all this new money into the economy, doesn't it?
Not necessarily. Bond yields are still very, very low. In the US, even at the current pace, we might get a 10-year rate of something like 2% by the end of the year. And relative to what the economy is going to grow in cash terms, in nominal terms, it'd be very, very strong this year, much higher than that 2%. So the US Treasury is still getting a good bang for its buck. And there's a good economic argument, actually, that what you need to do after a big shock like the COVID pandemic is get the economy back to full employment as fast as possible. So there's some economic logic to what the US Treasury is doing. The other thing to keep in mind here is that central banks are telling us that they don't plan to raise interest rates anytime soon. Yeah. And again, there is some good economic justification for that. What we're seeing is rising inflation expectations, but the underlying data shows that Core inflation is still low. Wage risks are still low. Economies are far from full employment. They still have lots of spare capacity. And all that together means the economic fundamentals point to some low inflation, but the economic recovery points to some faster inflation. So central banks are going to tell us that they won't raise interest rates soon. Right. And then probably a year from now, when they start to see that inflation in the actual data, then it will be the time for central banks to signal that rate rises will come.
They've been saying this for a while, haven't they? I mean, Jerome Powell said it a few times last week, and he had to say it again when he started to see all these inflation concerns pushing up the yields on government bonds. So, I mean, surely that was an indication. Middle of last week, I mean, it recovered fairly quickly, but surely that was an indication that the markets were saying, you might be saying that, but we don't believe you.
Well, the market, the central bank thinks is slightly overreacting at the moment, and that's the key point. When it comes to the central bank, there's a paradox here, because if the central bank wants to keep interest rates low in the short run, the way to do that is just to buy more bonds, just to push the value of those bonds up and the interest rates back down. But that, in the end, is actually stimulus, and bond markets are currently reacting to what they think is a lot of stimulus coming through the pipeline. So the medium-term consequence of buying more bonds would actually be to push up the yields, because it would push up inflation expectations. So there's a bit of a balancing act for the Fed. So what the Fed, the ECB, the Bank of England will do is signal in the near term they won't be hiking interest rates, they won't be easing up on their asset purchases. But beyond that, once the inflation risks do start to materialize, they'll signal that then will be the time to raise interest rates. And what that will do is it will hopefully contain inflation expectations. You know, central banks have these 2% targets. Yeah. If central banks think they can keep inflation expectations anchored around 2%, that would mean that this rise in interest rates eventually will reach a level. But the key point here is interest rates should rise because the economy is improving. That's the key point. Central banks don't want that rise to happen so fast that it could disturb or jeopardize the near-term economic recovery, and that's the challenge they face.
It's been quite telling, though, hasn't it, how this is in the United States and in Australia and a few other parts of the world. Europe is clearly lagging, and, you know, we're seeing this optimism in the States. We're starting to see the US dollar slowly start to recover a bit because the euro is losing ground. And this is all really, isn't it? Because they're dithering about on the vaccine. So does that mean we are going to see more strength in the US dollar simply because the euro is losing ground? And the pound isn't being dragged down with the euro. The pound is staying out there with the US dollar, isn't it?
Well, the pound looks like a good medium-term bet. We've ended the Brexit uncertainty. Fundamentally, the UK is a strong economy, and when it comes to the inflation and growth outlook, it looks a bit more like the US. And of course, we have the rapid vaccine progress. When it comes to the dollar and the euro, there's probably more downside for the dollar in the long run, simply because global investors will become more risk on during this upswing. They'll sell their safe US treasuries and they'll buy assets in Europe. The near term, you're right, we may get a bit of a mid-cycle rally in the dollar. The thing is with the vaccines, and this is the thing I would emphasize, I'm pretty convinced that by summer, the advanced world is going to be awash with vaccines, including Europe, and will be rapidly vaccinating. So the difference between an economy like the US or the UK that can probably open up soon because of vaccine progress and countries that just have to wait until the warm weather comes along and leads to the seasonal remission of the virus is probably 6 to 8 weeks. That doesn't change the economic fundamentals too much. What really matters is whether or not populations are sufficiently vaccinated by next winter so we can avoid repeat lockdowns. And then the big difference between the US and Europe is, of course, the fiscal response. The European fiscal response is more modest. Yeah. It's focused much more on investment, whereas the US, as you mentioned, they've gone pretty heavy on the front end to try and get the economy back to full employment fast.
So that would be an argument, wouldn't it, for the weakening of the dollar? I mean, if you're creating a lot more US dollars, then surely you'd see the strength of the dollar weakening, wouldn't you?
Well, in a fundamental sense, yes. What you'll get near term actually is the relatively fast US recovery versus other areas, actually leading to stronger demand for US assets because you'll earn higher returns. But in the long run, what you'll probably find, and just keeping in mind here, the US economy really is the conductor of the global economic orchestra, right? What the Fed and the Treasury do matters for us all. And if they create excess demand in the US, which is essentially what the bond market is telling you why inflation expectations are going up, the US is an open economy. What will happen is US consumers will start buying German automobiles, French and Italian luxury goods, and it will create demand elsewhere, and you'll probably find a global reflation as a result of this big stimulus drive in the US.
So what about China in amongst all of this? Because China's recovery obviously was relatively swift because they came out of COVID first. They do have a problem, of course, that they have to wait for the rest of the world to catch up because they've got people have got to buy the stuff they're exporting. So how important is the speed of their recovery to the rest of the world, to us, for example? Because, I mean, there have been small signs, and very small signs, that speed of recovery might be slowing a little bit.
The outlook for China is complicated. As you mentioned, it's already above its pre-pandemic GDP. It's the only major part of the global economy that is. There's a decent domestic stimulus, and China will benefit a lot from the recovery in global trade, which will likely happen this year. Remember, last year, producers really reduce their stockpiles, but consumption has been quite strong. So there's a necessary restocking which China will benefit from. But then, say, over a 3, 4, 5 year view, it becomes complicated because China's underlying growth potential is slowing down. It's losing its erstwhile momentum that it once had as an emerging catch-up economy. And what it's trying to do is maintain an artificially high growth rate through stimulus, and that actually worsens its long-run potential because it causes capital misallocation. And then you have this problem of essentially Western economies becoming much more suspicious about China, and that will lead to some deglobalization in goods and some delinking from China. So China's got some real structural problems. In the near term, it looks relatively strong because it's coming out of the pandemic fairly well.
There we are, Kallum Pickering talking about misallocation of resources, like a true blue economist there. What about, I mean, I guess in China's case as well, I mean, the fact that they have recovered so quickly means they have grabbed market share from the rest of the world. So there's going to be a bit of rebalancing because other countries are going to try and claim some of that business back, aren't they?
There's a little of that. I mean, one thing I would always hesitate is to think about the world as a kind of fixed pie where we talk about the distribution resources. I mean, what we really will see is a growth in the world economy over the next few years. And I am actually quite optimistic that we could be heading into a very good decade, combining stronger productivity growth. You'll remember it's been weak for the last decade with more inflation. The world could probably start to look a bit more like the late 90s, early 2000s period rather than the post-Lehman period. And it's partly because actually there's lots of technology which is available that we've just not really absorbed, but the pandemic has forced us to do that. So we've had a lot of diffusion of technology through services. We've also got this big policy tailwind. There's renewed confidence in what policymakers can achieve, especially on the fiscal side. We know that central banks can end a panic. We realize that actually governments can do more borrowing and more spending than we had thought without creating significant risk. So we've got this good policy tailwind with robust animal spirits and lots of available technologies for us to incorporate into economy. So things are actually shaping up well. The world for the next decade looks much better than it looked over the last decade.
Yeah, well, look, we should end on that positive note. But is the takeout from this the fact then that, you know, governments can give the economy a shot in the arm and the economy is going to do well from it, and we should be less fearful of building up government debt? We should be
as long as the money goes to good use, we shouldn't fear government debt. That's the key point. And for markets, what we experience is short-term volatility as we adjust to a higher growth and inflation outlook. But ultimately, if the economy does well, markets will do well. The process of adjustment, though, is not always painless.
It's going to be a rocky road, in other words, but ultimately good will come out of it. And in that rocky road, just a final question is, what's the role of the retail investor in all of this? Because that has been one changing dynamic, hasn't it? It looks like we're seeing sharper turnarounds. You come in first thing on a Monday morning and things are moved perhaps more than they used to. Maybe that is because of the volatility, but I'm also wondering whether there's people dabbling over the weekend and that's having a bit of an impact. Is that adding to this volatility that we're seeing right now?
It's a complicated market at the moment. If I could just draw a distinction between, again, the last decade versus what I think the next decade will look like. The last decade has been good for markets because there's been lots of central bank liquidity and very low interest rates, but it's been very difficult, apart from basically the tech giants, for high quality companies to stand out. The next decade probably is less good for markets because interest rates will be rising on trend, but high quality companies can do well. So it's a much more interesting environment for equity investors, and probably it's a stock picker's world rather than just an investor's world to go into the index as was the last decade.
Well, thank goodness we have so many experts on It's the Business to guide us through it all. Good to talk, Kallum. We'll catch you again very soon. Thanks for coming on.
My pleasure. Thank you.
And very quickly before we go today, let's have a look at the newspapers today. The Times, digital pass to unlock Europe for UK tourists. Apparently, Brussels is working on a vaccine certificate plan so that we can all go on holiday and enjoy the sun this summer. Plus, Nicolas Sarkozy, the former president of France, has been given a year in jail for bribing a judge, a different judge. This judge, perhaps he was just upset that he didn't get a bribe. Maybe you should have bribed him too. The Daily Express leads with the one jab brings dramatic drop in hospital cases story, with the health secretary saying research is showing that an exciting 80% fall in admissions for over 80s has been shown as a result of the vaccine. Let's hope it's a vaccine. Let's just hope it's not, because we're all in lockdown and that's muddying these figures a little bit. The Independent also has the Sarkozy story. Plus, COVID variants are still evolving to peak fitness, with Professor Sharon Peacock telling the Independent the dominance of new and emerging variants suggests the virus is approaching a fitness peak, and the effectiveness of vaccines will be diminished by these variants. It's not encouraging, is it? The Guardian, meanwhile, Hancock seizes on data to urge the EU to think again about the Oxford jab. They definitely need to do something over there, don't they, to get their vaccine rate up. Plus, Annalise Dodds saying now that Labour will back new taxes, a new business tax. We had that strange situation yesterday, didn't we, where it looked like the Tory government was going to raise taxes and Labour were objecting to it, completely turning the world on its head. The Daily Telegraph tells us today that fewer than 10 COVID patients over 80 each day are sent to ICU now, which is good, obviously. And the FT, Sunak to arm City of London for fight back with listings shake-up. He wants to make this the place to raise capital with a nimble approach to regulation, i.e. less regulation, including ways that company founders can keep control over takeover decisions, and making Britain a global centre for SPACs. Yes, SPACs, which are special purpose acquisition companies. That basically means you raise capital, you could be listed on the stock exchange, then you use the money that you've raised to buy companies. What do you think of that? Is that our future? Setting up companies not to do something, but to buy something. Wouldn't it actually be better focusing on creating companies that actually make things, that create exports, rather than just buying existing ongoing entities? Maybe I'm just old-fashioned. That's it for today. Back again tomorrow morning. I'm Phil Dobby. Thanks for listening in today. Have a great day.
It's the Business with Phil Dobby. Listen online at itsthe.business or wherever good podcasts are found.